Next up is Rajesh.
Okay, let me begin by just thanking the sponsoring agencies and Jim and the other conference organizers for inviting our paper. Very impressed with the thoroughness with which they do this. I mean, half an hour before this presentation, I was checked on by 3 people to ensure that I was mic'd up. So that's the level of thoroughness that this conference operates on. So very glad to be here. This is joint work with a former colleague of mine, Dimuthu Ratnadevakara, who's now at the Fed, so there is a disclaimer at the bottom of the slide. So as this audience is well aware, there was an aggressive rate hike by the Fed in 2022-23, but the bank's response was not as aggressive. If you look at the green and blue lines, those are the average rates that banks were offering on savings and time CDs, and they were considerably less than what the market rates were. And what do we know? We know that there was instability. We did see, there is evidence that depositors, quote unquote, digitally walked away. They used online platforms to move their money to, let's say, money market mutual funds. And then these walks suddenly became extremely rapid, and because of social media, we had very fast runs in 2023, and we have some academic evidence on that as well. So what we're interested in is who left, and what are their characteristics? And that's what we try to figure out in this paper. And the way we do it is we use cell phone geolocation data to construct demographic profiles of bank depositors, and so that we can sort of observe how depositor characteristics impact deposit stability. Okay? And what do we find? I mean, perhaps not unsurprising to many of you, across banks, and I would argue across branches, depositors vary considerably. That's what we see in the data in terms of age, income, education, and what we are calling financial sophistication, which I'll define a little bit in a bit. And what we find is that these depositor characteristics are related to deposit flows during this interest rate hiking episode and the rate setting behavior of banks. Okay? Essentially, the takeaway here is that banks with financially sophisticated depositors suffered greater deposit runoffs despite raising rates. Okay? Which led to losses in deposit franchise value. And we have some calculations in the paper, which I'm not going to preview here. So one good way to think about it is to think about what the source of this deposit franchise value is. So the easiest way to wrap your head around this is to imagine that you have some deposits D at the present time, a fraction of which remain when the interest rates are increased to R prime, right? And on these deposits, you make a spread, which is the R prime minus the beta times the R prime. So the beta here reflects how much of the interest rate, market interest rate, or what was your response to the market interest rate. So what fraction? Did you match it 1:1 or less than 1:1? Net of whatever operating costs you bore to maintain your deposit franchise, deposit relationships, right? So in equilibrium, things that work, banks know their depositors or their deposit base, so they set the beta, which means the rate that they offer relative to the market rate. Depositors observe the market rates, withdraw some W. And what we're going to ask is, what is this beta, what is this W? that we see, and how are they related to the depositor characteristics. So how do we do this? We get geolocation data from cell phones at a fairly granular level, which I'll preview in the next slide. And then we match it up with a lot of the publicly available data. Okay? So here's what we essentially do. What we can observe is, if I can get this to point. Yeah, what we can observe who the visitors or what the pings are at a particular point of interest or location. So think of this as the bank branch. So we know the address of the bank branch. We also know from the summary of deposits data what the branch's address is. We can sort of standardize these, match them, and then we know the number of visitors to this particular branch from the census block group, which is a fairly granular unit. And if we know the people who are coming from that census block group, we can aggregate it to the census tract level, which is just one level higher, to get all their characteristics. And we were happy that we were able to do this for about 76% of all the branches that are the summary of deposits data. So, I mean, as you can see, we're not missing a whole lot. Okay. So here's what we do. So imagine you are branch I, and you have visitors coming in from different census tracts, and we know the income levels at every census tract. So all we're going to do is weight the incomes at every census tract by the number of visits to get a sense of what the income level of the depositors who are visiting this branch is. Okay? And we can do this for every characteristic that we can observe. And if we can do that at the branch level, we can aggregate it up to the bank level. And that's what this is. And so what do we see? And here we're breaking it down by different bank sizes. So to this audience, columns 1 and 2 may be of particular interest, right? And as you can see, I mean, there is considerable variation across sizes as well, right? I mean, income levels rise as you go with larger banks. Smaller community banks tend to have depositors who are, shall we say, less wealthy relative to the larger banks, less educated in terms of college education, slightly older, and what we're going to call financially sophisticated based on, where they're sensitive to the interest rates going down in 2020. Did they refinance? Do they have capital gains? Do they have tax returns with dividends? So they tend to be less financially sophisticated as well. And there's considerable variation. I mean, the dark blue is the big banks, the light blue is the community banks. And if you look at each one of these characteristics, you see there's considerable variation in every size group. And for every characteristic that we're looking at. So we're going to call financially sophisticated depositors, or a bank or a branch, we're going to classify as having sophisticated depositors if it has its customers come from above median income levels, above median college educated, above median receiving dividend income, and above median refinancing their mortgages. And these thresholds are going to vary based on bank size categories as well. So they're very size adjusted. Okay? So we have some variation in the depositors. Do we have variation in the interest expenses at banks? And if you look at quarter 4 of 2023, again, The dark blue is the large banks, the light blue is the small banks, and you see a lot of variation in the interest expense. And if you look at panel B, you look at the change in the interest expense over the time period of the rate hike. Again, you see a lot of interest variation, which is basically saying that banks are responding very differently in their deposit interest rate responses. The question is, are these related to depositor characteristics? And so what we've done here is plotted differences between banks with sophisticated depositors and those with financially less sophisticated depositors. And time zero is, I think, December 2021. So if you follow this along, you're beginning to see that banks with more sophisticated depositors increase their rates far more than those with less sophisticated depositors. So banks are aware of their depositor base, they respond with higher rates. What happens to flows? Now again, if you look at various kinds of deposit categories and you look at the variation in the flows across bank sizes, you see considerable variation. I mean, just look at core deposits or just look at insured deposits. There's considerable variation in the amount of deposit flows across banks. And once again, if you look at the difference between these flows at the bank level, between banks that have sophisticated depositor bases and those that don't, you begin to see that once again, right after the Fed starts raising interest rates, you begin to see the outflows increase for banks with sophisticated depositors. Okay? Now, one could argue that, look, you're doing all this at the bank level, maybe different banks operate in different markets, they have different models, etc. But we can look at this at the branch level too. So within a bank, across its branches, if you look, we still see considerable variation in their depositor bases and how the flows and rates are, how they change, okay? Here's not a particularly good visual representation, but you can sort of see Ohio here. Okay, so this is Ohio, this is Huntington Bank, and red indicates branches with high levels of deposit changes, flows, blue, less so. And you can see, you know, I mean, less so in Indiana, up. You can see there's considerable variation across Huntington's branches. Okay? And these variations can be explained by depositor characteristics. So they are related to the depositors that those branches serve. Okay. Again, you see this across bank sizes. So if you just focus on, these are just differences. These numbers are the differences between banks with sophisticated and less sophisticated depositors across different size classes. And that's just the regional bank constituent, you know, the ones in the Key-Bruyette index. And again, you see that whenever you have sophisticated depositors, you see the outflows are higher. In other words, there's negative deposit changes. We've done a couple of other things just to make sure that what we're observing is indeed happening. I mean, you know, we've looked at banks, we've looked at their website traffic, you know, who's visiting, and even if you control for all of that, I think that, you know, what we're observing is still exists. I mean, physical visits matter. It exists even before SVB collapses. So this is not happening because of SVB, it's in response to the rates. We see this even if we were to just use deposit interest to total deposits instead of interest expenses, total interest expenses. So even if banks were to change their funding composition, we're still seeing this. So we're going to rule out all of that. Surprisingly, I mean, it doesn't seem to be related to the unrealized losses that banks suffered on the asset side. Okay. So there are some puzzles that we feel that are there, but that's for a different discussion. But I think what I'd like to conclude with is that banks with more or financially sophisticated depositor bases increase their deposit rates more, experience greater deposit outflows, which reduce their franchise values. So you can compute, I mean, if you have more deposits leaving and you are paying higher interest rates, the present value of your liabilities is going down. Okay? What does this suggest? I mean, I think, the regulators are already thinking about it, and I think there's some merit to taking a more granular approach to deposit modeling. So when you think of liquidity coverage ratios or other things like that, and you're trying to think about a 30-day projection of how cash flows might, what your cash outflows might be, given the speed with which these are happening, I think it is useful to take into account what kind of a depositor base the bank has. I think that would be interesting to sort of look at it. So with that, thank you for listening to me patiently, and I await Mary's and Matt's comments. Thanks.